Still scrolling for the next hot stock? Stop. In 2026, you can own the entire U.S. market, the developed world, stability, and a cash-like buffer with just 4 ETFs. No guessing, no FOMO. And did you know VTI, which tracks nearly the whole U.S. market at a 0.03% fee, returned around 14% annually over the past decade? That's the power of broad exposure doing the work for you. Here's the twist. 2 funds do most of the heavy lifting for global diversification, and the other 2 keep your emotions from wrecking returns. If you've felt analysis paralysis, this is your set it and forget it map, starting with why timing is your real enemy. So let's tackle the real drain on performance. Stop market chasing and the hidden cost of trying to be right. What if the biggest drag on your returns isn't a bad stock pick, but your own timing? You scroll, you wait for the right entry, and when a stock surges, you chase. When it falls, you bail. That loop feels like control, yet it quietly taxes your results more than most bad picks ever will. We call it analysis paralysis on the way up and fear on the way down. The outcome is the same: too many trades, buys after spikes, sells after dips, and a portfolio that works harder than you do but still lags. Here's the part most people don't see until years later. The typical investor often underperforms the very funds they hold because of poor timing. Dalbar's research has shown this behavior gap for decades. Fear and greed lead investors to buy high and sell low, missing rebounds and compounding losses. That gap compounds. By year 10, even a few percentage points of underperformance stack into a gulf that's hard to close. Think about the math. One investor captures more of the fund's return, the other trims gains by jumping in and out, plus they pay extra fees. The difference doesn't show up in week 1, but it gets very visible by year 10. Let's make it concrete. 2 friends each put $10,000 into a broad, low-cost ETF on day 1. One sets auto-invest every month and lets dividends reinvest. The other trades on headlines, moves to cash during scary weeks, and re-enters after rallies. A decade later, the steady investor rides compounding and minimal expenses, while an average return near 10 to 14% for broad U.S. exposure over the past decade and a 0.03% expense ratio like VTI's, their balance can climb meaningfully. Roughly the difference between letting compounding work uninterrupted and constantly resetting it. The trader's record shows buy high, sell low moments, adding trading cost and missed rebounds. Earning closer to 5% because of timing mistakes and friction, they end up with a much smaller balance. The cause isn't lack of research, it's behavior. Cost add to the problem. A 1% higher fee sounds small, yet over decades it becomes a large slice of your ending wealth. Contrast that with paying 0.03% in a broad market ETF versus 1% or more in higher fee products and trading costs. 2 portfolios with the same starting amount and the same gross return will finish far apart if one drags an extra percent every year. That is the relentless math of compounding working against you instead of for you. More holdings don't fix this. Complex model portfolios with 10, 15, 20 tickers still rarely beat a low-cost core plus discipline. If anything, more moving parts create more chances to tinker. Set it and forget it reduces decision fatigue, which is where many mistakes begin. When contributions and dividend reinvestment run on autopilot, you remove the need to guess. You just show up, fund the plan, and let the system do the heavy lifting. Here's the better path. 2 ETFs can quietly give you broad global equity exposure without stock picking, while a bond sleeve and a cash-like buffer protect your emotions when markets lurch. This 4 ETF framework isn't theory, it leans on real track records. Broad U.S. exposure with low fees has delivered, while disciplined behavior captures more of it. So what if owning the next winner is as simple as owning all the contenders today? Let's start with the engine that makes that possible. Start with the core. Your anchor, VTI, is the market, not a bet. One fund can serve as your engine. You get the broad sweep of U.S. businesses in a single move, so your results don't hinge on a single stock call. It frees you from picking, guessing, and second-guessing, while still capturing the growth that shows up across thousands of companies. VTI sits at the center for a reason. It tracks roughly 3,500 companies across large, mid, and small-cap stocks in one wrapper, and it does it at an expense ratio of 0.03%. That tiny fee matters because every basis point you don't pay stays in your account and compounds. Over the past decade, that broad exposure delivered about 14% annually, turning $10,000 into roughly $37,000. You're not trying to outsmart the market with this piece. You're owning it end to end and letting the economy do the heavy lifting over years, not weeks. You might worry it's just a big tech bet, or that you'll miss the next breakout name. Here's why that concern fades. VTI uses market cap weighting. As companies grow, they naturally take up more space in the fund. If a giant stumbles, its slice shrinks without you doing anything. The process quietly leans into strength and away from weakness. You don't have to rotate sectors or chase headlines. The index does the adjusting inside the fund. Think about Nvidia 5 to 10 years ago. Most people didn't own it, but if you owned VTI back then, you had it. And as Nvidia rocketed up, you went along for the ride as its weight increased. The same mechanism applies across thousands of firms. Winners rise in weight as their value increases, laggards become a smaller drag. This built-in rebalancing to success is the core advantage of broad, cap-weighted exposure. Dividends add another layer. VTI pays around 1.4% yield, so a $10,000 position throws off about $140 a year. Turn on automatic reinvestment, and those payouts buy more shares every quarter. Those additional shares then earn future dividends, creating a flywheel effect that builds without extra effort. Over long stretches, that reinvestment boasts total return more than most people expect, because it keeps compounding during both calm and turbulent markets. Discipline turns this from a good idea into real dollars. Automate your contributions into VTI at regular intervals so you don't wait for a perfect entry. Pair that with dividend reinvestment, and you've removed two of the biggest timing traps. You'll buy more shares when prices are lower, fewer when they're higher, and you'll keep moving forward without second-guessing every headline. VTI is the set-it-and-forget-it engine for U.S. growth. It isn't a trade, it's a foundation that lets everything else in your plan work. But leadership doesn't sit still forever, and concentration in one market can cut both ways. The next step is simple. Add a second pillar so strength in other developed markets can show up in your results when the cycle turns. Which brings us to the second pillar. Don't bet the farm on one country. VEA for global balance. VEA, the Vanguard FTSE Developed Markets ETF, gives you broad access to developed markets outside the US in one move. Europe, Japan, Canada, and Australia, so your results don't rely on a single country cycle. You keep the simplicity of a core fund while opening the door to roughly 3,900 companies you might otherwise miss. You might think international has lagged lately, so why bother? Short streaks can feel like forever when you're watching month to month, but cycles turn. International markets led in the early 2000s and in the 1980s. This year alone, VEA is up over 24%, while the U.S. total market sits around 10%. A live example of how leadership can change. Valuations reset, currencies swing, and policy paths diverge. When the dollar weakens or foreign earnings get re-rated, leadership can flip without warning. Owning VEA means you don't have to guess which year that flip shows up. You're already positioned for it. Look under the hood and you'll see names that stand on their own. ASML dominates advanced lithography. Novo Nordisk reshaped metabolic treatment. Toyota sets the standard for manufacturing scale and hybrid leadership. Add SAP to that list and you've got exposure to software, healthcare, industrial strength, and autos, global franchises operating under different economic regimes than the US, with cash flows not perfectly synced to the S&P 500. Research keeps pointing to the same blind spot: home country bias. Most investors overweight the market they live in, even when that means higher concentration risk. VEA counters that by spreading your bets across roughly 3,900 companies in Europe, Canada, Japan, and Australia, with a low 0.05% expense ratio that lets more of your return compound. Over the past decade, VEA returned an average of about 7.9% annually, turning $10,000 into roughly $21,300 while keeping cost minimal. You get breadth, depth, and cost control in the same package, which is exactly what a core international sleeve should deliver. Dividends add another layer. With a dividend yield around 2.6%, a $10,000 position generates about $260 a year. Reinvest those payouts automatically, and you convert income into more shares and more future income. The sector mix differs from a US-only fund as well, often leaning more toward financials, industrials, and exporters, which can smooth the ride when US tech cools. That blend of dividends and varied sector weightings helps reduce the bumpiness you feel when one theme dominates headlines. You're not taking a flyer on emerging risk here. VEA focuses on developed markets, where reporting standards and regulatory frameworks tend to be more predictable. That supports the core goal: broad exposure with fewer surprises and less reliance on any single economy. With VTI and VEA working together, you've got global equity coverage without picking winners, timing currencies, or guessing the next cycle. The question now is how you stay invested through the rough patches when stocks lurch and headlines get louder. When stocks swing, you need a counterweight that steadies the whole plan. Your shock absorber? BND, to keep you in the game. BND, the Vanguard Total Bond Market ETF, acts as your ballast by spreading money across roughly 11,000 U.S. investment-grade bonds. About 70% sits in government debt, with the rest in high-quality corporate bonds rated from AAA down to BBB. No junk bonds. That breadth means no single issuer makes or breaks your result. This is the calm part of the portfolio, designed to do its job without chasing headlines. The common pushback is that bonds don't grow. They're not supposed to chase peaks. Their role is stability and income, so you can stay invested when the stock side whipsaws. Over the past 10 years, BND returned about 1.8% per year, turning $10,000 into roughly $11,953. Modest, yes, but that's not the point. The point is drawdown control and cash flow. When equities sink, high-quality bonds have historically helped reduce the hit, softening the drop that can trigger panic selling. That cushion matters because the biggest portfolio damage often comes from bailing at the bottom and missing the early rebound. Think about two identical portfolios. Both start with the same dollar amount and the same stock exposure, but one holds 25% in BND. When stocks slide hard, the bond-anchored mix falls less. That smaller decline makes it easier for the investor to keep buying on schedule, reinvest dividends, and avoid turning volatility into a permanent loss. The all-stock version might recover on paper, but only if the investor actually stayed in. Behavior turns the gap into dollars. Yield is a real part of the equation. BND's dividend yield is about 3.77%, so a $10,000 position generates roughly $377 in annual income. You can reinvest that automatically into more shares or direct it toward the side that's lagging when you rebalance. That simple rule: sell a bit of what held up, buy what fell, systematically harvest volatility without guesswork. Costs stay in check too. BND's expense ratio is just 0.03%, matching VTI, so more of that income and stability remains yours over time. BND's role shows up in real time as well. Year to date, it's up around 4.97%, a solid result during a choppy backdrop that demonstrates its shock absorber profile. Research on market stress shows correlations between stocks and high-quality bonds often stay low enough to matter when you need it, which is exactly when discipline tends to waver. There are risks to respect. When rates rise, bond prices fall, and longer duration bonds move more. BND spreads duration across the total market, which helps, but it won't be immune to rate moves. Sticking to investment grade and avoiding junk in your core keeps the focus on reliability rather than stretching for yield that disappears when credit stress hits. In a core holding, prudence beats reach. BND isn't about excitement, it's about staying power that protects your long-term compounding. The final piece makes that staying power even more practical by covering near-term needs so market moves never dictate your next step. Which is why the fourth piece focuses on liquidity and rules you can actually follow. The fourth piece, cash-like buffer and implementation rules. This isn't about outperforming stocks. It's about having a dedicated safety net so your plan runs uninterrupted. Use a short-term treasury or money market ETF as a cash-like sleeve. Think category, not a single ticker, so you can choose a low-cost, high-liquid option from your provider. Hold 3 to 12 months of living expenses or earmarked purchase money here. Keep volatility low and access high. When a bill lands or income dips, this bucket covers it instead of your equity sleeve. You're protecting compounding by keeping growth assets in place. People skip this step to chase a little extra yield, and that's when forced selling shows up. A layoff, a medical bill, or an unexpected move often hits during market stress. Selling stocks then locks in losses and breaks your process. A cash-like ETF prevents that. It buys time and gives you certainty. Short-duration treasury and money market ETFs carry very low interest rate sensitivity, deep liquidity, and, when rates are elevated, competitive yields without taking credit risk. You get stability, quick access, and modest income that can top up the buffer or flow back into your core when it's full. Here's the implementation. Treat the buffer as separate from your main allocation. Fund it first to your target months, then automate contributions into the core 3 ETFs, VTI, VEA, and BND. Money arrives, the system deploys it on schedule. No headlines required. Use the buffer for 3 cases: covering living costs during job disruptions, paying for planned expenses within the year, and bridging short-term surprises so you don't sell risk assets into weakness. Refill the buffer with new cash flow before adding it to the core if it drops below your target. Set clear allocation ranges for the core portfolio. A straightforward, research-aligned mix might center around VTI, VEA, and BND with flexibility by horizon and risk tolerance. For example, growth-leaning investors tilt more to VTI and VEA. Conservative or near-retirement investors tilt more to BND. Keep the buffer outside those percentages so you don't confuse near-term cash with long-term investments. When a major purchase is within 6 to 12 months, increase the buffer and reduce equity risk accordingly. Once the purchase passes, redeploy back to target. Rebalance with rules. Use a calendar, quarterly or annually, or set bands, such as rebalancing when any sleeve drifts 5% points from target. Trim what outran the plan and add to what lagged. That's harvesting gains and buying value without prediction. For taxes, broad equity ETFs tend to work well in taxable accounts due to low turnover, while bond income often fits better in tax-advantaged accounts like 401ks or IRAs. Turn on automatic dividend reinvestment to keep compounding clean and consistent. Put together, you now have U.S. growth, global balance, a bond shock absorber, and a cash-like buffer guided by rules. Next comes the part that matters most, letting this process, not your feelings, run the show. Here's where the plan comes together. Conclusion: wealth grows when your process beats your feelings. You've built a process that runs itself, VTI for the US engine, VEA for developed world balance, BND for stability, and a cash-like buffer as the fourth component to cover near-term needs. That's how compounding gets room to work without constant decisions. Now, act. Pick your allocation, automate contributions, and set a simple rebalance rule. Then stop hunting headlines and let the rules do their job. You'll spend less time worrying and more time letting the math work. If you want more depth, start with this framework and tailor the ranges to your horizon and risk.